My guest on the show today is Amitabh Sonthalia, Managing Director and Chief Executive Officer of SKS Capital, a very old and renowned firm of Kolkata. Mr. Sonthalia, welcome to the show. Thank you for joining us. Indian markets are up 20% this year, and this year indeed Indian markets have managed to climb the wall of worries. On a daily basis, we are seeing deadly volatility, deadly volumes. What to your mind exactly is happening then?
Yeah, hi Nikunj. We had a strong run this year, as we all know, in Jan and followed by Feb. It seems like we made a short-term peak at 5,600 in the near term, ahead of the key events that are likely to unfold in March, starting with the UP election results next week. Then we have the railway and the union budgets, and in between the credit policy as well. Now, markets have taken a somewhat positive view on the outcome of all these events ahead, and going into these events. I think the fact that we've corrected a bit is somewhat positive. The fact that expectations are getting tempered. So I see a month of consolidation ahead of us, and a bit of volatility that we've already seen is likely to continue based on the various outcomes of the various events that we've talked about.
Right. There is a divided house on how should one read into the current market rally. To your mind, is this a new bull market rally, or this is just a sharp and a very swift bear market rally?
Technically, it does look like we're in a new bull market, with the falling trend line of the last 18 months having been broken decisively on the upside. Markets moving way past its 200 DMA, sustaining above that, correcting close, it tried to correct and retrace to the 200 DMA, but it's still holding well as of now. So, and corporate fundamentals are somewhat mixed. So as we typically have, markets typically move, ahead of the fundamentals improving. And as I mentioned, the fundamentals are yet to improve decisively. In terms of the quarter gone by, as we know, the corporate results have been a mixed bag. We've had some disappointments, but by and large, the results have been somewhat better than expected, I would think. And so that's now behind us. The Q3 GDP numbers that came out yesterday were also below expectations. That also is behind us. So the economy now hopefully is in the process of bottoming out. There have been a lot of key policy announcements of late which have excited the markets. Now it remains to be seen whether we can maintain the trajectory in terms of positive policy measures by the government and fiscal prudence in the budget. That will set the tone for the markets, I think, in the next quarter. But for now, I think it's a phase of consolidation, correction, and cooling off that we're going through. And we'll just have to wait and see how the events unfold over the next fortnight or so.
So if you believe that we are closer to a correction, how deep to your mind could be the extent of the correction?
It's anyone's guess, Nikunj, but I think markets can retrace maybe up to 50% of the recent rise if the events don't turn out to be favorable. But I would think that even if the events turn out to be unfavorable and markets are disappointed in the short run, if the global liquidity trends are strong and liquidity flows are strong and the global sentiment is strong, then we would still probably find a higher bottom somewhere in the next month or so, and which should set the stage for a second quarter rally again. But I would not like to, we would just have to wait and see how the events unfold to sort of get a sense of how deep the correction could be. But my sense is that it may not be very deep at the moment.
The US Fed is committed to keep interest rates lower till 2014. LTRO2 has started and Bank of Japan is pumping in money. So do you think liquidity is here to stay?
At the moment, it seems like liquidity is strong, and all the measures that, the various governments have taken in the US, Europe, Japan, etc., as you mentioned, will be supportive of an easy liquidity situation globally, and will be supportive of risk assets, including Indian markets. So, that's just at the moment it seems like things that does seem to be in our favor, even though, the sentiment in terms of the corporate sentiment and the fundamentals of the economy don't seem very good or strong at the moment.
What are your key assumptions for Indian markets for the year 2012 and then beyond?
On the economy front, we've had a pretty, a weak third quarter, with the investment cycle remaining a drag, and we've seen a second quarter-on-quarter decline in gross capital formation, and the full year GDP numbers also will likely fall short of the CSO advanced estimates of 6.9%. Going into FY13, I think the growth is still at risk, and we're likely to see a 6 to 7% GDP growth range, which is likely to disappoint quite a few. So I think on the economy front, a lot remains to be seen and done for us to really be confident. And the macro picture is even though we have a declining rate scenario ahead of us, is still not looking that great.
So, Amitabh, to your mind, what are the parallels between this year's rally, or this year's market rally, and the rally we saw in 2000?
Between 92 and 99, we pretty much stayed in a broad range of about 3,000 and 4,500. And it took about 7 to 8 years for the index to really break out of that consolidation pattern or range. I have reasons to believe that we might be in a repeat of that situation, that if you take 2007-8 as the last peak of the market, we've already double topped at about, in 2010. And now we're likely to test those highs again perhaps over the next 1 year. But for markets to really break out of this range, it'll take some more time. So the scenario that I'm looking at over the next few years is perhaps a consolidation or a bouncing around in a broad range of about, say, 14,000 to 21,000 for the Sensex. And so having said that, I think we're now on the up leg of the move, and but we're going to see the cycles, as you know, are getting shorter and shorter. In fact, even in the 90s, we had these 12 to 15 month bull and bear markets between 92 and 99 or 2000, and a similar pattern is being repeated now.
So what, to your mind, will be a good investment strategy for the current market environment? Buy or hold, or we are nowhere close to a buy or hold strategy? This year we will get big spikes like we've seen in last 3 weeks, a 30% spike, and investors and traders, they should capitalize on that spike.
Well, for 2012, again, I don't believe in forecasting or making predictions, so I don't want to make a specific projection for the year end, etc. But at the moment it seems like we're in a buy and dips market. So until anything drastically happens globally or in India, I would stick to that strategy that, after a bear market of 14-15 months that we saw from 2010 till about December 2011, we're likely to see about a year's up cycle. So typically the cycles, even in the 90s and in the last 4-5 years, have lasted between 12 to 16 months. So if you look at a Jan 2012 as a base for this upcycle, then it has about a year. We have about 12 to 15 months to where this upcycle can last. And as we said, it's unlikely to be a one-way trend. And I think it is reasonable to expect that we're going to see another down leg for sure after that. So for now, it seems like buy and hold as a long-term investor on the broader market in general may not work. If you're a smart stock picker, you can still make perhaps 5x returns by holding on over a period. But on the whole, from a portfolio strategy perspective, one has to sort of play these 12 to 15 month trends that we've seen in the 90s and now for the last 4 or 5 years in the Indian markets.
What is your view on high beta names, the infra, the metals and the banks?
I think more than high beta, what has really done well in this market is those really cheap asset plays, the value buys, the ones that got hammered down. You can call them high beta, but I think the rally is in some of these high beta names have been driven by the fact that they were not necessarily earnings play in the short run, but more asset plays. And so asset plays are just another sort of different way of looking at value. So value could be in value you can have different perceptions or different measures of value. One is earnings, the other is book value or asset plays or net asset value. So I think in general, I think value plays have done well, and value should continue to do well rest of the year.
When you say value, define value for us.
Value is, I would think, defined by both in terms of earnings. What constitutes low value for me is when a stock is at a low PE, for example, or when it's trading at a cheap relative to its net asset value or breakup value, or price to book ratio, typically, as one would think, or dividends is another measure of value. So a high dividend yield typically indicates a higher value. And of course, in the end, value is all about, growth is also a part of value. So I don't think there's necessarily growth it has to be value versus growth. And essentially what growth investors are betting on is the fact that what looks like a growth stock now and a high multiple will actually become a value stock a few years hence. So earnings growth should also is sometimes, if one can predict and one has reasonable confidence in the earnings growth of a company, then that leads to a good value as well. So combination of all of these factors, I think, is what constitutes value.
So rather than asking you to bet on a range, let me ask you a question on PE band. What, to your mind, is the ideal PE band for the Sensex?
Well, historically they've traded in this 11, 12x to 20 odd x PE band. So I don't think there's any reason to believe that markets would significantly deviate from that band. But that's not something. I don't look at a Sensex PE necessarily too much, because that can be misleading sometimes. I would be happy to look at a basket of securities or a portfolio that I'm invested in, what the average PE or the average valuation measures of that basket is, more than the Sensex PE. But yes, Sensex performance or the leading index performance does have a bearing on the individual stock performance. So that's, to that extent, we do look at that.
So what exactly is the trader Amitabh Sonthalia doing and the investor Amitabh Sonthalia doing?
Because at the moment, as we said, we're giving some time to the markets to consolidate. We're waiting to see how the events unfold this month. We are somewhat reasonably invested to the extent of 75 to 80%. We're holding 20-25% cash across our portfolios to invest in over the next month or two. And we're still in, it's work in progress. So at the moment we're kind of holding on to our horses and not trying to do too much.